All right, let's dive right in. Today, we're digging through a mountain of Wall Street research to make sense of a crisis that's unfolding right now. See, a critical artery of the global economy has just been severed, but for some reason, the broader financial markets, they seem bizarrely calm. So what is actually going on? Let's follow the data.
So I want to start with something that I can't get out of my head. Right at this very moment, in some of the most dangerous shipping lanes on the entire planet, captains of these massive oil tankers are typing a really strange new message into their public broadcast systems. It's not their destination, it's a declaration. Owner, China. Entire crew, Chinese.
So why on earth would they be broadcasting that specific kind of cryptic message? Well, this isn't some rare glitch. It's actually a clue. And it's the key to understanding this massive disconnect between what's happening in the real physical world and what's happening in the financial markets. What we're witnessing here is a brand new form of geopolitical camouflage. It's it's a desperate plea, really, an attempt to wrap themselves in a safe haven flag, to basically scream to any potential aggressors, "Hey, we're not your target, move along." It has become the only reliable insurance policy out there on the high seas, and the reason they need it is because of where they are. They're all trying to get through the Strait of Hormuz. I want you to think of this place as the jugular vein of the global oil market. A huge percentage of the entire world's energy supply has to squeeze through this one single narrow waterway. It is, without a doubt, the single most important choke point for the global economy, period. And that right there is the core of our story today. That choke point has effectively collapsed. The whole geopolitical insurance thing of declaring Chinese ownership, that's a last resort, because normal, everyday traffic, it's ground to a near total standstill. And this chart just illustrates the sheer scale of the problem perfectly. I mean, just look at this thing. That red line, that's the moving average of oil exports sealing through the strait. You can see it falls off a cliff. We are talking about a mind-boggling 96% drop from normal levels. The lifeblood of the global economy has just stopped flowing. And to put a really hard number on it, analysis from Bernstein calculates that a full sustained closure of the Strait of Hormuz would yank 15.3 million barrels of oil per day right off the market. That number? It's just staggering. Now here's where it gets really crazy. How does this potential disruption stack up against history? Take a look at this table from JP Morgan. It lists all the big supply shocks going back to 1950. You got the Arab oil embargo, the Iran-Iraq war, the Gulf War. Now look at that column for peak monthly supply loss. None of them, not a single one, even comes close to the potential disruption we are staring down right now. This is an order of magnitude bigger than anything we have ever seen in modern history. Which, of course, brings us to the central mystery of this whole thing. We have what looks like a historic, catastrophic supply shock in the most important commodity on Earth. And yet, the broader financial markets are acting like it's just another Tuesday. Just look at this comparison for a second. Over here on the left, you've got crude oil prices going completely vertical. That's a clear signal of pure panic in the physical market. But then on the right, you've got the S&P 500, which is basically the US stock market. And it's barely even flinched. It's hanging out just a few percentage points off its all-time high. The disconnect between these two charts is it's jarring. So what gives, right? If the engine of the world is literally running out of oil, why isn't the stock market pricing in a massive global recession? Well, Wall Street analysts are pointing to three key clues that might explain this bizarre sense of calm. Okay, so here are the three big reasons. First, not all oil prices are actually telling the same story. Second, the US economy has this unique kind of structural buffer against this specific kind of shock. And third, and this is the really crucial one, the market is making a huge, huge bet that this whole crisis is going to be over and fast. Let's dig into that first point about prices. The oil prices we all hear about, Brent and WTI. Yeah, they're high, but they're also kind of misleading right now. They mostly reflect what's happening in the Atlantic, which has a nice cushion from strategic reserves. The real stress, the real story, is in the Middle Eastern prices, like Dubai and Oman. Those prices are screaming physical shortage at the top of their lungs, because Asia is the one feeling the deficit first, and they're feeling it the hardest. And this brings us to the single most critical variable that every single analyst report is obsessing over right now: time. The question isn't just if the strait is closed, it's for how long it's closed. the market's entire reaction, its calm, it's all one big bet on that timeline.
So here's how the outlook totally changes depending on the clock. If this whole thing lasts just a few weeks, okay, the market can handle it. Prices stay high, but it's contained. But if this drags on for 1 to 3 months, the whole conversation shifts to stagflation and a really serious risk of recession. And if we go past 3 months, well, a severe global growth shock becomes the main scenario. And at that point, pretty much no asset is safe.
I think this quote from Bernstein's analysis just sums it up perfectly. We're past the point of simple knee-jerk reactions to scary headlines. The entire market is now a function of this crisis clock. The difference between a 1-month shutdown and a 3-month shutdown isn't just a slightly higher oil price, it's a completely different economic reality. So, with all this uncertainty hanging in the air, how are the big-time strategists actually positioning their portfolios? Well, this whole situation is forcing them to write a completely new defensive playbook, and frankly, it might not be the one you'd expect. A really clear rotation is starting to emerge from all their research. On the strength side, you've got the obvious stuff, the energy sector itself, of course, hard assets like gold and rare earths, and also defense and infrastructure. Then on the weakness side, you see things like software, consumer-facing businesses, anything that's sensitive to credit, and especially expensive, unprofitable tech companies that rely on cheap money. So if you boil down all the advice coming from firms like JP Morgan and Goldman, 4 key themes keep popping up. 1. Play relative strength. Go long the strong sectors and short the weak ones. 2. Use commodities as a hedge because historically, oil and gold are the most reliable. 3. Favor hard tech, meaning companies that build physical stuff over soft tech like software. And finally, remember that in a global energy shock, the US dollar tends to be a primary safe haven. And all of this brings us back to the final and most important question. The quiet we're seeing in the broad market right now, it's really just one giant leveraged bet that this whole thing will be resolved quickly. But all the data shows that if this situation drags on for months instead of weeks, the real pain hasn't even started yet. So the billion-dollar question we're all left with is, what happens if that bet is wrong?